It is the top of the hour, so let's begin. Got a great crowd here today, and so quick rules of the road, comments from me, a little bit about the portfolios, and then Derek Allen is going to talk to us about the guide to retirement and a few quick retirement planning scenarios, various other stuff that's covered in the guide, important factoids for everybody to know. And for those of you, if you are a 401k participant on our 401k platform, we ask that you follow along with this, and our employers can also make sure to share this particular video because it will give count towards education and your education component for the year. All right, so with that, very quickly, the usual rules of the road. Everybody's muted. Everybody's video's off. If you've got questions, you should be able to raise your hand or go ahead and send an email to my email address. Other folks are monitoring it, so they'll ping me and let me know. And so that way we can do Q&A at the end, not in the middle of the call. So that's the rules of the road for today. And next, that brings us to various projects, important state of the firm stuff. So as I've reiterated, we've been incorporating a lot of new technology this year, making a number of upgrades, making a number of changes. So this month, one of the things that I want to focus on is the fact that we did move servers for the financial planning software. It's the same financial planning software. Don't worry. Everything looks the same. You're still able to use your same username and everything else, except we've now got a link right on the homepage so you can access the financial planning software. You'll also see that we've made a couple changes to the website that allow for the scheduling link to be right there. So you don't actually have to try and keep a secret link bookmarked or try and field those things down. And so that will make your life a little bit easier in terms of the reporting, in terms of some of the stuff that we can see and do. Those are the simple pieces. We are going to be also incorporating a couple of more things. The quarter did just end, and we did just get through the bulk of earnings season. So that's had a lot of volatility. So you guys have seen some trading and some rebalancing. On that same note, diving into the rebalancing trading that you'll see in your accounts, you're going to see a little bit more rebalancing probably in the coming weeks. What we've seen recently is that interest rates have kind of stabilized, with 10-year being around this 1.6 number. At least it's been that way for the last month or so. So aside from a few basis points here and there, we've been relatively around that number. And what we've seen is we've seen a little bit of a pullback emphasis on the growth side of tech. We've seen Apple come down. We've seen Zoom Video come down substantially. We've seen Lemonade. We've seen some of these various other names. They've all repriced after their significant outperformance last year relative to the S&P 500. And so that's going to begin to represent kind of a buying opportunity for us. So you may see us start to establish some positions in some names like a Zoom Video, a small portion of the speculative trading portfolio, or simply with the more ETF-based portfolios, us rebalancing and moving, leaning forward, if you will, into those equity positions, trying to take a position and be prepared for that eventual upturn. It's not easy to watch this volatility. It never is on that side, but that's the reason that we stay diversified, and that's the reason sometimes we make the hard or the difficult decision. And it's something that I've learned over the years. It's something that has paid off really well, and it's certainly for rebalancing purposes. Last year at this time, for those where we use that volatility to our advantage, it worked out very well ultimately. With that, keep an eye out if you've got questions, if you've got comments, and you want to talk about your accounts specifically. Feel free to pick up the phone, send an email, give us a call, go onto the website, request a meeting, etc. And we'll talk about it personally and together. With that, Derek Allen, I'm going to turn the page over to you. I think I've given you hosting permissions. I think I've given you sharing permissions. And so I'm going to sit here and learn from your cues and what you have to teach us today.
Yeah, William, can you hear me?
I can hear you. You sound great.
Perfect. Appreciate you having me on the call today. Certainly appreciate the commentary at the upfront, and as always, appreciate the time and attention from everybody on the line. I know over the last year we have all been through a lot of Zoom meetings, whether it's with family, friends, or for business, and to take the additional time to either watch live today or watch the recording is a compliment, and it's one that's taken very seriously. So what we will try to do is make the most of our time together here. First of all, we'll try to make it a little fun with a story about Harry Houdini, and then we'll talk our way through some of the essentials of successful retirement. This is one of the things that, on a daily basis, we spend a lot of time at JP Morgan talking about the markets. We talk about interest rates, talk about individual ideas, and that's what William and I get together with frequently and talk about. But some of the principles that we're going to go through today actually come from our 401k team. They're vetted in years and decades of participant research, and the idea is pretty simple. People are pretty bad at doing the simple things, right? And as it relates to the simple things about retirement, it's saving, it's spending, and it's investing. And we'll talk through an equation that we had put together a couple of years ago in a paper. Before I do, I'm just going to talk a little bit about risk. And William, in his open, talked about some of the risk in the market today. Some are dissipating, some are increasing. One of the things that we always talk about risk is the riskiest things are the ones that you don't see coming. The example that we give is of Harry Houdini, and I'm actually standing at a standing desk. I have my feet planted. I feel like I'm ready to box. And I bring that up about Harry Houdini because a lot of people knew that he was a famous magician, an entertainer, but a lot of people are not aware that he was actually an amateur boxer. And as an amateur boxer, as part of his show, he would actually invite what he perceived to be the strongest male or female in the room up on stage and give their best shot to give him a punch in the stomach. And he could withstand it without even a flinch. And he did this time and time again, and it became a regular part of his show. And one day after a show, he invited a group of kids backstage to spend some time with him, to learn a little bit from him. And one of the kids walked up to Harry as he was sitting in the chair and started punching him as hard as he could in the stomach. And what ended up happening is he caught Harry Houdini off guard. He didn't see it coming. He didn't have the opportunity to flex his stomach the way that he usually would. The next day, Harry Houdini died of a ruptured appendix. Right? The riskiest stuff is the stuff that we always don't see, or the stuff that we don't see coming. Harry Houdini was once handcuffed, placed inside a dead whale's stomach, escaped through his mouth, nearly suffocated in the process, but he survived because he had the opportunity to prepare and he knew what was coming, right? And risk always works like that. You want to have the opportunity to prepare for what's coming, but as it relates to the market, who really knows where it's going to come from? Right? If you think about the prior bull market that we experienced from 2009 to 2019, a lot of people had a similar type of response. I want to wait to invest because of risk A, right? Whether it was Ben Bernanke's monetary policy, whether it was President Obama's fiscal policy, whether it's President Trump's fiscal policy or trade war, all of those things reduced people's willingness to participate in the bull market. And lo and behold, it ended up being a virus. Right? It was a virus that ended up causing the recession that we saw. So the next time you think about participating in your plan's 401k, you think about contributing to your IRA, you think about taking money out of cash and investing it in the market, think about that before de-risking or before thinking about de-risking, because at the end of the day, you're not going to be able to prepare for whatever's coming next. The only thing that you can do is develop a plan, right? And as I alluded to a second ago, there are a couple of things that we'll try to do in today's conversation, right? So first, we're going to talk retirement. So we'll talk about some of the fundamentals. How much do I need to retire? When can I retire? How should I think about how much income I'll need in retirement? We'll talk not necessarily about your retirement plan, but we'll talk about some potential actions to consider as it relates to your MO, or you're thinking about investing within your particular plan. Now, a couple of things first, right? We have to consider within this investment landscape or within the investment retirement landscape, what is our objective, right? And at some point throughout the course of your conversation with William, you've probably talked in some way or in some fashion about your goals, right? What are my short-term goals? What are my long-term goals, medium-term goals, and what are my long-term goals? And depending on which of those buckets we're talking about, your allocation or the way that you think about investing those dollars is going to be different. I opted to not wear a tie and a suit jacket in today's presentation because I'm now starting to go out and do in-person meetings again. As doing in-person meetings again, that means I have to put suit and tie on again. So I'm fighting as hard as I can on every Zoom meeting that I do from here on out to not have to put the suit and tie on. So that's my short-term goal at this point, right? As it relates to short-term goals in investing, those are generally 3 to 6 months out. That may be that reserve cash or that reserve part of the portfolio. That's something that you may need to tap. As it relates to 401k land, most of that is going to exist in that medium and longer term bucket, right? If you think about the money that you're putting to work into a deferred account, you're more than likely deferring the opportunity to then take that money out until age 59 and a half, right? And as such, we want to then rethink the type of investment philosophy that we have, where as we get into that 5 to 10 year bucket, we're thinking more about equities and less about bonds as part of that overall allocation. Again, equities potentially more risk, but a little bit more potential upside. And over the 15-year time period, again, shifting more towards equities and away from fixed income. On the bottom of the page, what we also show you is the volatility over time also comes down regardless of how you're invested, right? On the left-hand side of the page, you'll see over a 1-year time period, the upside and downside potential that you would have seen in the stock market going back to 1990 is you could have been up 38% or you could have been down 37%, right? Bonds are representative in the gray here. So if you invested in bonds over a 12-month time period, you could have been up 18 or you could have been down 3, right? If you were in a 50-50 portfolio, which is the purple, you could have been up 28, you could have been down 16. And over that same time period, that short-term bucket, which ends up being essentially cash, was flat to up 7%. Now, as you move to the right on the page, what you'll actually see is that those lines come together, right? We go from here to here as we move out on the risk or on the time spectrum. And if you look at 5 years and 10 years, what you would actually find is stocks don't go from up 38 to down 37. They go from up 18 annualized to just down 1% annualized over a 10-year time period. Said another way, it's very rare that you actually lose money in an all stock portfolio. But not all of our portfolios are going to be all stock. Bonds have returned 8% annualized at the high end, 3% annualized at the low end. Again, a 50-50 portfolio, 13 and 3, and that cash portfolio still 0 to 5%. And over a 20-year time period, right? Given all the things that could happen over 20 years, all the unanticipated risks that could potentially punch us in the gut, again, you've made money in stocks, you've made money in bonds, you've made money in a diversified portfolio, and more money than you would have made in cash, right? As you think about your 401k investments, as you think about your longer term bucket, which is traditionally going to be that 401k contribution, that IRA contribution, stuff that you're not going to need in the next 3 to 6 months, that bucket you can be a bit more risky because over time, the potential range of outcomes comes down and it creates a scenario in which you can just focus on the important things, which is the retirement equation. This equation is actually an output from a paper that Catherine Roy, our chief global retirement strategist, wrote in 2013. The name of the paper was The Importance of Being Earnest. You can find it, but it's a little bit dated at this point. What's not dated is the Guide to Retirement, which is the book that she updates every quarter. And this is actually page 3 from that Guide to Retirement. If you're interested in getting the Guide to Retirement, feel free to ping William after this. If you're watching the replay, feel free to get in touch with your plan sponsor who can get in touch with William. And he can send you over these slides. And this slide is really important. And some of the context behind the slide was we put together this equation. And what you'll notice is there's 3 different colors here. The 3 different colors represent your level of control, right? What control do you have over your own ability to retire? On the right-hand side of the page, you'll see that out of your control is things like market returns. As much as William and I would love to say that we can control what's going to happen in the market tomorrow, we can't, right? The market is the market. Over time, we know what to expect or what we can expect, which we saw on the prior slide. But in the shorter term, we have no control over what happens in the market. For the most part, and I'm careful saying this in the DC area where I'm currently recording, we don't have much control over policy regarding taxation, savings, and benefits, right? Any one individual isn't necessarily going to be able to affect this policy. We operate in a democracy. So while we can lobby for certain things, and there's a lot of that in this area, at the end of the day, we really don't control what happens, right? In the bottom left-hand side, you see some control. So you do have some control of your employment earnings and duration. Do you retire early or do you end up working a couple of extra years, right? Where do you decide to work? All of those things. Longevity, again, something you have some control over, right? Genetics obviously play a big part, but you can choose to do things that may add or subtract years to your life. And those things are things that you have some control over. The things that you have total control over are your saving and your spending and your asset allocation and location, right? Asset allocation is what we just talked about, stocks to bonds. Your location is in what vehicle. So do you put money into a Roth IRA or do you put money into a traditional IRA, excuse me. What was interesting about the paper is what they found is 80% of your ability to retire depends on the purple. 80% of the average participant's time is spent on the green, right? So we spend 80% of our time talking about what the market did today, what the market's going to do tomorrow, what President Biden is going to do with his infrastructure plan, what's going to happen with the tax cuts or potential tax increases. At the end of the day, the takeaway from the paper was 80% of your ability to retire are the things that you have complete and utter control over, which is your saving and spending and your asset allocation and location. And so that's what we're going to try to focus on today. We're going to try to hit on those buckets. We're not going to try to predict where the market is going. We're going to try to predict the behavior that's going to be beneficial to help you to get to where you need to go. So let's start with income replacement. Why is this important, right? If you go back to 1981, there was a shift from corporations and defined benefit plans. So you worked for a company and they would give you a benefit for the rest of your life, right? Again, in this area, you still have pensions, government pensions, and ultimately, those are fixed, right? In the early 1980s, there was a shift towards private, right? I now, as an individual, have the responsibility to fill my own retirement bucket. In the pre-retirement phase, the blue represents here is that you're living on or your income replacement, for example, of $150,000 gross annual household income is 100% on you, right? Your income comes in and you pay your mortgage and you pay off your kid's school, or you pay for your kid's school, or you pay for daycare, whatever it might be. We have a 10-month-old baby, so daycare is top of mind for me right now. If you look on the right-hand side of the page, in post-retirement, a couple things do happen, right? You may say, okay, well, I'm not really going to do that much in retirement, right? I'm not going to be as active as I am now. Well, you take out some of the pre-retirement savings stuff. Changes in expenditures only account for about 8%. So the change in spending isn't as dramatic as a lot of people expect. And actually, in the first couple of years of retirement, you tend to see the spending go up. So again, you probably need more than you think. Change in taxes. So as you get older, as your income comes down, your tax bill comes down. That means your overall replacement rate ends up being about 74% of your pre-retirement income, right? About 27% of that for a household of 150,000 is going to come from Social Security, right? And as somebody that's still in my 30s, the thought of Social Security still being there in 30 years is something I think about quite a lot. The other 47% is on you, right? That is up to you and or your employer, if you happen to have a match, to fund your retirement income needs. And it's important to think about what bucket you fall into, because that's a $150,000 household, right? What we just talked through is in the middle of the page here. But if you're a $300,000 household, which is more common in this area because you have a higher cost of living, you're actually going to be about 60% on your own, right? Your income replacement is only going to be about 12% from Social Security. The other 60% is actually going to come from your pocket. That means you probably need to save more than you think, right? If you work your way to the left-hand side of the page, I grew up in Iowa and my family's still in Iowa. The average income there is a bit lower. So there's probably going to be more of a reliance on Social Security in that case, right? You're looking at, in the case of a household that makes, call it minimum wage, of $50,000 a year, about 53% of their benefit or their income after retirement is actually going to come from the government. So a little bit less of an onus, but also the ability to save less per paycheck. So the question is, when should I start saving? And the answer is immediately. The sooner you start saving, the better. And page 19 from the Guide to Retirement gives you the benefit of time, right? Time is the one thing in investing that we know works. And if you look at the slide, we give you a couple of things here. There's 4 different portfolio options. Essentially, when did I decide to start saving? How much did I decide to save? And then at the end of the day, how much of my portfolio is based on market returns or compounded returns relative to how much of my portfolio is just the stuff that I put away, right? And if you look at the example on the page here, at the very bottom, you see this green box, right? $121,000 at the end of what ends up being a 45-year time period. This is an example of nervous Noah. And I bring this one up first because this is actually a lot of what we see in 401k land. There's a lot of money in 401ks of younger individuals that's sitting in the stable account, right? Fully invested in cash. And what we did here is we looked at an individual named Noah that was saving $200 a month into an investment account. That investment account ended up being cash, which on average gave him 1.1% per year. So starting at age 25 until age 65, Noah put away $96,000. At the end of that time period, that $96,000 was worth $121,000. That might sound great, right? I put in 96, I get back 121. That's not the worst thing in the world until you look at the other end of the spectrum. Right at the top of the page, you see consistent Chloe, and these are fictional characters, so don't try to find their LinkedIn pages. But what you ultimately find is consistent Chloe did the same thing. She put $200 away every month, only $200 every month, from age 25 to age 65. But Chloe put her money into a diversified portfolio that ended up annualizing 5.75% a year. That same $96,000 grew to almost $370,000, and almost 74% of her portfolio ended up coming from the market, right? It came from market return as opposed to her own personal contribution. So as we go through a couple of the next slides, you might say to yourself, I'm never going to be able to put that much money away, right? I have a lot of expenses. I need money that I need to spend. There's a lot of things that I'd like to do personally. And I don't know if I'm even going to be in retirement at some point. Who knows how long I'll end up living. The important part is to start saving early, because the earlier you start saving, the more the market will ultimately give you. And that's what gets to the next slide. If you look at late Lila, so this is the other example. And if you're 35 right now, don't be discouraged, right? Still important to start saving if you haven't started saving, because again, if you look at late Lila, she didn't start saving until 35, right? Let's say from 25 to 35, she was having a wonderful time traveling and doing all the great things that we like to do. She ended up putting away $72,000, annualized at 5.75% a year. That ends up being $192,000, right? $192,000 is still a lot better than the $121,000 that Nervous Noah got over the exact same period of time, right? So it's important to get in the market, right? It's important to start saving, but it's also important to start investing, right? Cash over the next couple of years, and William mentioned this in the opening comments, cash right now is not giving you 1.1% a year. Nervous Noah is actually earning closer to 0.1% a year. So that 96,000 is not 121, it's probably a lot less. So it's important to not only save, but it's important to invest and let the market give you some of that retirement savings that you're going to need over 30 and 40 years that a lot of us are looking at. Real quickly, page 13 of the Guide to the Markets. Again, this is kind of the do-it-yourself slide. So if you say to yourself, well, that's all well and good. I didn't start at age 25, but I have started saving and I think I'm closer on track. The first and most important point would be talk to William, right? He'll go through that calculation with you and can have a conversation about what you need to do. But this is kind of an easy way to just gauge whether or not you might be on track. Again, there's a lot of assumptions on the right-hand side of the page. Annual gross savings rate, pre-retirement investment return, post-retirement return. All these are going to be wrong, right? These are all hypothetical assumptions. What's important is the direction, right? And if you look at the example of the 40-year-old household, a 40-year-old with a household income of $50,000 should have saved $95,000 for retirement by age 40. If you don't have $95,000 saved for retirement and your income aligns with that number, the question is not I'm done. It's directionally, why aren't I there? Right? It's one of two things. It's probably a saving and spending problem. I'm spending too much and not saving enough, or it's an investing problem. Maybe you've saved $80,000, but you have it sitting in cash in your bank account, right? And again, it's never going to grow to be that 370,000 that we saw on the prior page if you don't take advantage of compounding returns, which, as Warren Buffett said, is the eighth wonder of the world. So we go through a couple of different scenarios here. Obviously, if your income is higher, your expectation to save is higher. So if you look at the 10% annual savings growth rate, and again, a household that's making about $100,000 a year, that would assume that you need to take 100,000 times 2.3. You should have saved $230,000 for retirement. Again, directionally, if you're not there, the question is saving versus spending or investment, right? The pre-retirement investment return here we have is 5.75%. The equity market has given you a lot more than that over that same time period. So it's worth having a conversation about what's the appropriate level of risk that we can take. You know, page 16 of the Guide to the Markets is what if I haven't started, right? What if I am in fact a 40-year-old individual that makes $50,000 a year that has not saved a single penny for retirement? The answer is, going forward, you may need to save close to 17% of your paycheck in order to be able to get to that number, right? 17% sounds like a lot. So again, a conversation about how do we take 5.75 to get 6.75 or 7.75 can have a substantial impact, right? It can take that 17 down to 10 or 15, which may be a bit more manageable. So again, higher income households here. As we jump into, I guess what I wanted to get into next was just the importance of being in the market, right? The most important thing that we've talked about here today is that idea of being able to compound your return and getting invested in your retirement plan. Page 43 of the Guide to the Markets is one that's very timely, right? William mentioned some of the volatility that we've seen as earnings have come out, as we've started to get later into this kind of pre-cycle period where we've got this reopening trade going on. And there's a lot of potential anxiety where you may look at your 401k balance and say, you know what, we've done all right, right? We've done pretty well. We've made it to this point. Let's just go to cash, right? Let's take it all off the table. Let's get out of the market because I think that things are going to get really, really bad. And we're going to sit in the market for 30 days, right? The point of the slide is if you try to get out of the way of some of these decisions, right? Timing the market is two decisions: to when to get out, but it's also when to get back in. Because what you tend to find is the best days and the worst days cluster together. So if we look at the slide, $10,000 investment in the market on January 2nd of 2001 to December 31st of 2020 would have annualized about 7.47% in a year, or 10,000 turned into 42,000, right? Not bad. If I'd missed the 10 best days over the last 20 years, I would have returned 3.35% a year, or only ended up with about 19,000. If I missed the best 30 days, my money would have actually been negative over that time period. And the key is really here in the middle, right? 7 of the best 10 days have occurred within 2 weeks of the 10 worst days, right? Last year in 2020, we had one of the 6 of the 7 best days occurred after the worst days. The second worst day of 2020, March 12th, was immediately followed by the second best day of the year, right? So if you want to time when to get out of the market and when to get back in, that's ultimately going to cause a situation in which you probably miss out on some of those best days, right? And you don't end up getting some of the compounded returns that we were talking about in the prior example. You end up getting a slightly different experience that isn't going to get you to the retirement goal that we had talked about in the prior slide. Sorry, I was scrolling down as opposed to up, which is where I was trying to get to. Getting back to the slide that we looked at goals-based advice, thinking about how we want to invest our money and how we want to grow our money. If we try to time the market right over this 20-year time period on the right-hand side of the page, you might not end up with that 6 to 10% return. You may be looking at something a lot lower. And based on the slide that we looked at with Nervous Noah, if we get 1% as opposed to that 6 to 10, it's going to be a lot harder to be able to retire. So, William, I'll wrap up my comments. I'll open up for any questions. I know some of this may have seemed intermediate to some of the folks on the line, but you'd be surprised at the amount of people within our own business that sometimes forget. I'll admit, as I was walking through some of these slides with my wife yesterday, as we were talking about the presentation, she was pretty surprised to find some of the numbers that we walked through. And I don't know if it's going to stop her spending as much as she does, but it was certainly worth a shot. So William, I'll pass it to you. And if there's any questions, I'm happy to take them.
Sure thing. Let me check the feed here and see if we've got anything that's popped up. And if not, I've got a couple of questions that I will fire off to you. All right, so I don't see any questions that have popped up in the feed, but I'll go ahead and throw a couple out. And by the way, thank you very much for that chart about missing the 10 best days. I didn't realize that just missing those 10 best days was quite as substantial as it was. So now, when we talk about saving for the future, I always make the statement about, and I get the look of as if I have six heads, about the idea that you need to think about it in terms of getting to that 15 to 20% number. And I always back into it from Social Security, employer match, and then what you're putting away. And it looks like some of this data is borne out in this. Now, what's the life, one of the things I do have curious about, what's the life expectancy of those retiring folks? Is it you're going to walk out the door at 65 and collect a paycheck, and then, we have a sort of mortality around age 95, or is that through age 100, especially for our younger generation? I know I'm getting a little long in the tooth, so I don't quite get there, but there are some younger folks on the line, like the 30-year-olds.
Yeah, life expectancy is a really important conversation, because people don't truly appreciate what it means, right? If I'm working for 30 years, right, when Social Security was first established, it was set up with a life expectancy. It was set up at age 65 with a life expectancy of age 68, right? We're now looking at life expectancy numbers that are in the late 80s and in some cases the early 90s. So in the assumptions that we put on page 14, we actually assume 30 years in retirement. Right? In some cases, there are a lot of retirees that are going to be in retirement longer than they're working. And what that means is they're going to need to have substantially more saved. And the assumption here is 30 years. If you end up going 35, right? The 10% annualized gross savings rate is also assumed from age 22. So this assumes as soon as you graduated college, you started making the exact amount that's on this page, and you started saving exactly 10% every year. Most of us don't start making our lifetime income at age 22. So if you made 50,000 a year for the first 10 years of your career, and now you make 100,000, right? Your number is not 10%. You're gonna have to save more than that, because now your income replacement is higher. So as you had mentioned, the 15% or so is actually a number that we think is a lot more important. And if you look again on the right-hand side of the prior page, which depends on your income, in the case of the 300,000-year-old individual or 300,000 a year individual or higher, you're actually looking at a savings rate that needs to be closer to 20 to 30%, right? And that's assuming that Social Security is going to be there at some point, and that's assuming that you're only looking at 30 years of retirement. Again, the higher your income, the more likely it is that you retire early, and that means you could be looking at 35 to 40 years of retirement. Factor into that the possibility of paying for children's education, for children's education. And the numbers continue to add up. The important thing I would say is that returns can help, right? The investing portion of this, while we can't predict market returns, getting 5% a year as opposed to 1% a year makes all the difference in the world, right? That extra 50 basis points or 1% or 2% a year over 30 years compounded makes a really, really big difference. And it's really the difference between people being able to retire comfortably and potentially talk about generational wealth, as opposed to just being able to make it by and trying to make their money last until their waiting days.
Yep, I agree fully. And the other sort of the second piece behind that is, and I know you've got something stashed away in here, is the diversification. I am a broken record. I always pull out the same quote about the fact that diversification never works at any one time, but it works over time. And I think kind of what you've elaborated here, I think is worth sort of saying, okay, for that 50-50 portfolio, which by the way, looks really great long-term from retirement, shows you can't pick, the particular market sector, but, we can get a nice steady return and get a nice glide path into retirement.
Yeah.
I'm sure you have a couple of lines for us on that same impact in terms of guide to retirement, because I noticed when we went out 20 years rolling that the full equity portfolio lined up pretty closely risk return with the 50-50 portfolio.
Yeah, and if you go back to 2006, right? This is actually from the Guide to the Markets, but it's something that can also be shared with folks on the line. If you go back to 2006, so this includes 2008, and it includes 2020, the drawdown that we had in 2020. It also includes the drawdowns that we had in 2009 and 2010, right? The Euro debt crisis. In 2013, we had the taper tantrum. 2014, we ended up having again the European crisis part two. 2016, we had the election. 2017, and so on and so on and so on. And North Korea and the nuclear concerns. Despite all of that, over this time period, that diversified portfolio in the gray, to your point, never the best performing, never the worst performing, annualized 7.3% a year. That's better than the 5.75% that we were talking about in the prior page. And if you look at an all equity portfolio, it annualized almost 12% a year, right? That's more than double that we talked about in the prior page. So again, those numbers would be twice as much had we experienced this type of return as opposed to what we saw in the hypothetical situation laid out in the Guide to Retirement. So again, the importance, even every year there's another reason to get out of the market. There's another risk that you feel is going to punch you in the stomach. At the end of the day, we don't really know what it's going to be, but you have seen over time asset allocation. Asset allocation doesn't work at any given point in time. It works over time. And that's ultimately what we try to convey with some of the retirement saving charts.
Well, that sounds fantastic. And yeah, I didn't realize some of those numbers. So this, as you say, eye-opening to me as well. With that, I know that we are a bit over the half of the hour. And I'm looking around to see if there are any last questions that are coming in. Do we have any raised hands or anything like that for any of our participants on the line? If not, what I will do is let everybody go. So this is the sort of last call for questions. And if we don't have anybody, then I will go ahead and let everybody go to enjoy the rest of the day. So going once, going twice. All right, third time's the charm. And that concludes our May monthly State of the Firm call. As always, if you've got any comments, if you've got any questions, you want to talk about your particular accounts, or you've got some various commentary you want to add separately offline, questions for Derek, feel welcome to shoot me an email or shoot a note over to the staff and make sure that we convey that along, get questions answered and comments addressed. Same goes true for meetings and everything else. Keep an eye out for your inboxes. I know the staff has a number of things queued up for this month. And with that, it's time to end. So I will say good evening and bid everyone adieu until next month. And Derek, thank you again for being on the line. Go take care of that 10-month-old, and I hope everything is going quite well. All right.
Thanks, William. Appreciate it.
Absolutely. Great seeing you. All right.
Bye-bye.